Thank you for tuning in to the Financial Modelling Workshop with iKeep. My name's Simon Alsop. I've been an accountant working with small and startup businesses for the last 15 years, and even started fast-growing businesses myself. In this session, we'll be discussing the importance of a financial model and what significant benefits it can bring you, the founder of a small or startup business. We'll also be talking through the key elements of a financial model, which will lead into the process of how to build a financial model for your business. We've created a simple model in Excel that will be yours to download at the end of this session. Session 1, creating. Why is it important to create a financial model for your business? Almost all companies perform some kind of financial planning or budgeting, but there are particular reasons why a financial plan is important for startups specifically. Firstly, you need a financial model to prove that you're building an economically viable business. Because quantifying and then validating your business plan, your business model, assumptions, the things that you're hoping are going to happen in order for your business to work, your financial model is the way that you can turn these ideas and assumptions into a rock-solid plan. And this way you're better prepared for the future, especially if things don't go the way you thought they were going to. Secondly, you're going to need a financial model as part of the fundraising process. Financiers will typically ask you for a financial plan when they engage with you, whether they be banks, angel investors, VCs, or any provider, even the 3 Fs, friends, family, and fools. They're all going to want some sort of financial plan before they give you a dollar. I mean, certain investors are going to ask for more details than others. Some will be more sophisticated than others. But if you've gone to the effort of creating your financial plan as a startup, you're going to be ready for any questions that any of them throw at you. Thirdly, you're going to need a financial model to inform your shareholders. A financial model is a fantastic way for you as the business owner to communicate with your shareholders as to how your business is performing. Are you generating the cash you're expecting to generate? Are we ahead of it even? Or do we have some catching up to do? This is the way that you can set the targets for your business so that you can compare your actual performance against what your plan was. Section 2, how do we build a financial model? Often building the financial model itself is not the real issue. There are plenty of templates that you can find online. Just Google financial model and you'll find a raft of them that you can choose from. There are countless models out there. I mean, any Excel savvy friend will be able to help you put together a basic financial model. The real problem when it comes to creating a business model is how do you actually get the numbers that you put in there? How do you accurately forecast sales? How do you figure out what the market size in your sector is? Or even like, how much should I spend on marketing? And I guess to answer these questions, there are 2 main methods that we use with the businesses we work with. And these are called either top-down forecasting or bottom-up forecasting. So let's start with top-down forecasting. Using the top-down approach, you work from a macro perspective and then work towards a more micro view. Typically, you'd start off with industry estimates, and then narrow this down into of everybody worldwide who could potentially be a customer of my product, who is in a geographic region that I'm likely to be able to service, and then narrow this down even further on, given that there are other people servicing this market already, what's a realistic expectation on the size of the market that my business could effectively sell to? So based on sales targets you define with this model, the next step is to actually estimate all of the costs that are associated to build or deliver your product or service, and all the expenses that are associated with sales, marketing, research and development, general admin expenses inside the business, in order for your company to stay alive. When estimating the costs for your business, it's important that you aim for a point of profitability within a reasonable time frame. In other words, at some point in time, all the costs, expenses that your business is incurring need to be less than the revenue that your business is generating in order to have a positive EBITDA, which means earnings before interest, taxes, depreciation, and amortization. All right, next there's the bottom-up approach. I mean, the pitfall from the top-down approach is that it might seduce you into forecasting too optimistically, especially sales. I mean, often entrepreneurs calculate sales targets by taking a random percentage of the market without realistically assessing whether this target is actually achievable. A tiny percentage of a market might seem insignificant, but could be way too optimistic, particularly in the first year of your business operating. The bottom-up approach is less dependent on external factors like the market, but leverages company-specific data, such as sales data or your company's own internal capacity. So contrary to the top-down method, the bottom-up approach begins with an inside view of what your capabilities are, and then works towards the bigger picture down the track. So this means that the projection is based on the drivers from inside your business. So let's walk through a short example. Let's assume one of the main drivers of an online SaaS business is online marketing. One of its main online marketing tactics is to advertise on LinkedIn. The company could then define the cost per click using LinkedIn's advertising tool, estimate the number of visitors that's going to attract to its website as a result of that, and the conversion from a potential lead visiting the website through to converting as a customer. So based on the internal metrics of the company will have a good idea of the potential sales. And the only constraint on their potential sales is the amount of money that they've got available to spend on the LinkedIn marketing campaign. So performing the bottom-up analysis therefore does not force you to think about realistically what percentage of the market you can achieve, but it makes you think about, based on your marketing spend, what's the likely number of customers that you will achieve. So that's the opposite approach. The only catch with the bottom-up approach, however, is it's really difficult to create a forecast using the bottom-up approach that has a really steep growth curve. If every sale has to be rationalized on how it comes into the business, it doesn't ever take into consideration any viral marketing or relationship marketing or word of mouth. So what we tend to find when we're working with startup businesses and building the financial forecast, we generally tend to use the bottom-up approach for year 1 and year 2. You've got analytical data that you can be very confident in the number of sales that you're going to be generating. But often it doesn't get investors excited. You need a little bit of more spice and bigger dreams in order to get the investors on board. And so that's where, for a longer term projection, you might be looking to use a bit of a mix of the top-down approach. And so by using a mix of these two methods in your forecasting, you can generate a well-balanced and well-thought-through financial model inside your business. Next, let's have a chat about assumptions. Because no matter which approach you use to build your startup's financial model, it's crucial that you're able to substantiate the numbers with assumptions. As a startup, historical data is just not available, so you need to be able to present the proof behind the numbers that you're putting forward. This will also help you when you start discussing numbers with investors, as they're typically interested in knowing the reasoning behind your numbers. They're considering to put money into your company, and so you don't want to give them the feeling that you're just making it up as you go. Assumptions can be anything that validate your numbers. Assumptions are not guesses. Assumptions could be things like market research, web search volume, contracts with suppliers, pricing validation, historical sales, conversion rates, bills of materials, website traffic, you name it, third-party proof of numbers. And in this instance, it could be useful to create something like a data room, which could even be like a Dropbox folder, in which you collect these kinds of evidence behind the numbers you've used inside your model. By doing so, you're slowly building a library that underpins all the numbers that you've put into the model, so you're well prepared whenever an investor or a funder comes to you with questions in the due diligence process. Section 3, outcomes. Every sector, company, business owner, and investor is different. All of them have their own interests and value different business metrics. From that perspective, it's fair to say that every financial model has its own characteristics. Therefore, it's possible to customize every model for its user. However, a good financial model usually contains at least 3 of the following outputs: financial statements, an operational cash flow, and a KPI overview. In this segment, we're going to walk through those 3 parts of what should be in the outcome of your financial model. So, financial statements. Any decent financial model includes a forecast of the 3 financial statements. And by that, I'm referring to the profit and loss, the balance sheet, and the cash flow statement. Financial statements are the generally accepted way of communicating financial information across companies, banks, investors, the ATO, government bodies, basically anyone that we need to show or understand financial performance of a business in any sort of way. Since any financial professional is able to interpret financial statements, having financial statements included in your forecast is typically a requirement with practically any fundraising process. So let's walk through those 3 financial statements. Firstly, the profit and loss. This is what most small business owners are looking at pretty frequently. The profit and loss is basically an overview of the income and costs that your company has generated over a period of time and shows whether you're profitable or not. Does the revenue that you're bringing in exceed the costs that your business is spending? The P&L shows several crucial performance ratios as well, whether it be gross margin, EBITDA being earnings before interest, tax, depreciation, and amortization, and is very important for investors as it provides insights around the operational performance of a company and allows them to compare the efficiency between your business and other companies they might be looking at. The balance sheet is an overview of everything that the company owns, its assets, and everything that the company owes, being its liabilities at a specific point in time. When we're talking with business owners, we often differentiate the profit and loss and balance sheet between the profit and loss is a history lesson. It gives you a picture of what the business has done month by month or in a specific period of time up until this point in time. However, your balance sheet tells you your future because it's in the balance sheet that you've got the cash to trade or to buy things in the future. It's the balance sheet that tells you what bills need to be paid in the coming month. It's in the balance sheet. It tells you what assets you've got to put to work or what receivables, what customers owe you money that you can expect to receive inside the next month. So if you ever wanted a crystal ball to the future, we encourage look at your balance sheet to understand how the short-term future is going to be for your business. Next, the cash flow statement. The statement of cash flows shows all the cash going in and out of a company over a specific period of time. The cash flow statement consists of 3 separate parts: operational cash flow, investment cash flow, and the financing cash flow. The standardization and the separation of these 3 categories provides you or any investor insight on where the money is going and how it's being used within your company. Next, the operational cash flow. For fundraising purposes, the forecast of the financial statements are typically shown on an annual basis. Monthly estimates in most cases are not really needed because in early stage startups, it's more about showing the long-term growth potential than giving insight on the monthly operations. However, for the actual day-to-day management of your company, it's useful to include a cash flow for the next 12 months ahead inside your financial model. This addresses questions that the yearly financial statements cannot. For instance, about the timing of the cash flows throughout the year. Moreover, it provides you with an opportunity to track your actual performance versus your expected budget on a monthly basis. And in this case, it'll help you cut costs if needed and anticipate potential dips in the months ahead. By monitoring it on a monthly basis rather than the annual basis, it helps you get on top of your business in case it starts going off on a tangent that you don't want it to go on. To build an operational cash flow, you simply list all the categories of the cash inflows and outflows, for instance, in Excel, which is going to be included in the template that we go through. Add a starting cash balance in the template that we're providing to you. This is the yellow cell in the top corner. We then go down and have a look at the inflows, and the inflows could be from financial resources, and by financial resources I mean the owner contributing funds or receiving funds from a shareholder or funds loaned in the form of debt. The inflows. Once we've put down the inflows and the months that we expect to receive them in, we then estimate what the outflows are going to be. And the outflows could be any mix of things, from the cost of sales, the cost of delivering your product, the cost of product that's being sold. And it is also the operational costs of your business. It could be marketing costs, rent for the premises that you're in, phone, internet, insurance, and all these things. List them down in the month that they need to be paid. We then have a look at what capital expenditure do we need to set money aside for. Could be computers, the laptop, there could be machinery, depending on what sort of business that you're in. What sort of capital items do we also need to plan to spend money on? This then, with the starting balance, plus the money that we've got coming in, less the money going out, will tell us whether we've got enough money to do everything that we want to do this month. So let's just take a minute to have a look through the template together. And next, the KPI overview. The outputs of a startup's financial model typically include some company or sector specific KPIs. And by KPI, I'm referring to key performance indicators. As the name suggests, they're pretty important. So KPIs don't only matter for an investor, but also for you, the company owner. Based on these metrics, you can track your performance at the company, experiment with different acquisition channels, business models, or even cost structures within your business, and then use them to make your co-founders absolutely laser focused on the metrics and the targets that you define. There are KPIs that show sales and profitability performance, such as revenue growth rate, gross margin, EBITDA margin, profits. There are KPIs that are related to cash flow and fundraising, such as burn rate, runway, funds needed breakdown, or even company and industry specific KPIs. If you're in hospitality, this might be the number of covers that you've got to do in a particular day. SaaS companies, for instance, typically estimate track, amongst others, the customer lifetime value, LTV, customer acquisition costs, the ratio of these, and for SaaS businesses, understanding these metrics inside your business are absolutely crucial to survival and success. For your business or industry, some metrics might be even more important. Perform a bit of research on the web to understand what investors are looking for inside your business, what sort of metrics businesses in your industry are using to track their performance, and then figure out the ones that are most relevant to you and to your investors. And if they're important to your business, make sure they're included inside your financial model. Section 4, inputs. In this section, I'm going to take you through the 6 common elements that typically serve as inputs in the sheets that come together to make a financial model. Before moving to the different inputs of a startup's financial model, it's important to realize that financial modeling is not a goal in itself. It should be a means to an end. And that end is typically to get more insights on the financial side of your business and whether those businesses and what those insights mean for you or a potential investor. One of the greatest things you can get out of creating your financial model is validation that the assumptions you've got behind your business are actually going to create an economically viable business. A financial model is essentially a quantification of your overall business in numbers, and therefore it should reflect your strategy, your business model, and your vision. It's therefore fair to say that your financial model and your business model canvas are just two sides of the same coin. So let's get started on the inputs of your financial model. Firstly, revenues. The first input sheet of a financial plan is generally the revenue forecast. And revenue forecasts, revenue projections can be pretty tricky, especially when you haven't done your first sale yet. So how do you go about this? Typically, forecasting revenues is typically performed using a combination of the top-down and the bottom-up methods, which we spoke about earlier in this presentation. Use the bottom-up method for your short-term sales forecast, say for years 1 and year 2, and then use the top-down method for the longer term, say the 3 to 5 year goal ahead. This means that you're able to substantiate your short-term goals, should you have any questions at a detailed level with investors or financiers, and while at the same time, your long-term targets demonstrate the desired market share that you're looking after and the ambition and excitement over the vision that an investor is looking for. If you find it difficult estimating the demand, then one way to approach this is to do some keyword research. There are plenty of keyword tools that can give you insights into the search volumes for keywords that relate to the product that you're offering. They can show you per city, per country, per continent, depending on how far your reach is with how you can deliver your product. And monthly search volumes that are done for a specific keyword on the internet. By using this research, it can give you a good indication for the demand for certain offerings compared across different countries and different locations. You could try, for instance, there are different tools that you can use for this. One of the most popular tools to understand what's getting searched for is Ubersuggest. So if you sell 3D printers, you could search for something like buy 3D printer and see how many people search for that word each month. So now you know the different approaches to forecasting. This is how you actually put that down onto paper. Firstly, list all of the products or services that you're going to be selling. Determine in which units you want to present your sales. Like for a soft drink provider, this could be the number of bottles sold, but you'd also have the option to do it in a number of litres or pallets as well too. So figure out how you're going to differentiate or how you're going to calculate sales and speak about sales inside your business. Forecast the sales unit and the number of units to be sold. So this is based on both the top-down and the bottom-up analysis that you've performed above. What's a realistic quantity that's going to be sold each month? Once you've got the quantity, it's then time to add the selling prices into the formula. We'll take you through the Excel model that we've got here as some examples on how we build out the pricing and the sales forecasts for your business. The way in which you build your revenue forecast depends a bit on your business model. The example that we've got in the Excel sheet here includes a traditional business model where it's literally the volume, number of units sold, multiplied by the price, gets you the projected income for the month. However, a SaaS business, if you're running a SaaS business, it could be better to prepare a revenue forecast based on your number of existing customers, how many new customers do you expect to acquire, and what's the churn rate. You can have a look at a specific financial modeling template for this if this is better suited to your business. On this screen, we've got an example of what the cash flow could potentially look like for a business. Now, we haven't put any real data into this template, so it doesn't make a whole lot of sense, but the structure makes a whole lot of sense in how it's put together. In this top cell, D6, we're putting our opening cash balance in. We appreciate that we might not be necessarily starting from day dot in the business. So if there is any funds in the bank account that we've got to start off with, you can enter that in the yellow cell here. You'll see every other cell on this page is drawing from one of the data pages that we've previously talked about. So if you see something here that doesn't sit quite right, click on it, but have a look where it's taking its information from and go back to the source and update the piece of information there. In this case, we're expecting a total cash inflow in July of $21,533. This is partially revenue and partially financial resources, which from what I recall was a founder contribution coming into the business. We've got some cost of sales, so the cost of the product that we're selling, and then we've also got the overhead costs sitting inside here. There was some capital expenditure, probably buying some computers, and there's also a loan repayment that's starting to get put back. And if we followed this business model to a T, given it's all dummy data, we'd actually find that we're $408 short from being able to deliver on this plan. So unless you've got an overdraft with your bank, it's really important to make sure that the figures down the bottom here are always positive. Next, we're going to have a look at cost of goods sold, otherwise known as the direct costs in your business. The COGS are those costs that are absolutely essential in delivering the product that your business is selling. So depending on the type of product that your business is selling, the calculation could be a little bit different. For example, a company that sells tangible products, they would include in their cost of goods sold any costs that they have incurred in getting the product to a saleable value. So we're talking about things like the raw product cost, we're talking about freight and import duties, should it be coming from overseas. We're talking about the labor that's, so the salaries, wages that go towards putting a product together and getting it to the point that it can be sold to a customer. So for a SaaS business, the COGS are a little bit different to your normal traditional business that's selling a product, as there is no regular production cost in putting together the item that's getting sold. However, SaaS companies indefinitely incur COGS, such as hosting costs, customer support, onboarding costs, and online payment costs. So from these examples, you can notice that all of these costs have to be incurred in order to produce or deliver the goods or service. You're still not quite sure how to calculate COGS for your business? One way of tackling this is by looking at the sales targets that you've defined in your revenue forecast. Let's assume you're selling a tangible product. From creating the revenue projections, you know already how many units you plan on selling in the next 6 to 12 months. From this, you work your way back. What's it going to cost directly in order to achieve that level of sales inside your business? So if you know what it's going to cost to produce one item of product in order to get one sale, then it's just a matter of multiplying that forward. And how to calculate COGS does depend on your business model. Sometimes it makes sense to forecast COGS on a total level, like per month, rather than individual unit by unit. Or it could even be a percentage of your revenues. It'll vary from business to business. The next tab that we've got in the financial model is the product tab. This is where we have a look at the projected revenue and the projected cost of delivering your product to the market. Again, like all the other fields inside this financial model, the goal is to type over any of the yellow fields. So if you've got, say, subscription revenue, what we get you to do is put in the number of customers you expect to have in any given month, and then what the average sale price is. By multiplying the number of customers by the sale price, you're going to end up with the estimated revenue for the month. If this type of revenue calculation is not relevant to you, just zero it out. Put it down to zero. Let's say, for example, you're a product business. You might be selling products. Here's where you can estimate the number of units in a given month and have a look at also at what the sales price is going to be. And if there's a cost at putting it together, we get you to fill it in here on row 23. You might find that over time, the products increase or decrease in price as you're starting to put larger orders through. Similar to the product revenue, if your business is selling a service, you can fill in the details below. Or maybe you've got some other type of revenue altogether. Figure out what's appropriate for your business and then just put zero through all the other sections. That's part of the joy of having a generic business model for many different types of businesses. The next section is overheads, otherwise known as the operating expenses of a business. And these are the expenses that a business incurs as a result of just performing its normal business operations. These are the costs the business incurs regardless of whether it makes a sale or not. So unlike the cost of goods sold, when revenue increases, these expenses increase, these expenses generally tend to be pretty steady, whether a sale is made or not. So typical operating costs for a startup will include events, traveling, legal costs, online marketing, payroll costs of people working in the business, not necessarily those that are putting the product together, as they'd be included in COGS. It could be accounting fees, rent, utilities, insurance, patent costs, IT costs, software subscriptions, rent, marketing, promo materials. There's a big list of things. They're discretionary expenses that aren't necessarily related to the product that you're selling. If you're not sure about which expenses you might incur in the long term, ask your accountant, or if you really want to get something on paper, some businesses use a percentage of revenue for this. I personally don't like that model because by nature, overheads should be fixed regardless of whether a dollar sale is made or not. Your overheads will remain the same. We're going to walk through together now an example of what operating expenses could be inside your business. And let's see which ones are relevant to you. The next tab in the financial model is the overheads tab. This is where we have a look at all the fixed business expenses that you're potentially going to be up for in your business. Now, we've put a little bit of homework into this to think about as many different things as possible, but obviously make it your own, type over the data as you need to make it relevant for your business. Here we look at things like marketing costs, whether it's flyers, how much you're going to put on online advertising, Google, direct marketing, and all of this. Type over it to make it relevant for your business. Then type in how much per month and which months you plan on having these expenses for. Then move down to office costs. Maybe there's platform costs if you're running a tech business. We've got an arbitrary number of $10 in there for all of these things, but we expect that you'll be typing over these and as you make it your own. After the office costs, consider things like utilities, insurance costs, motor vehicle, travel, legal, accounting. There's a whole bunch of things that we've put in there. So have a think through about what these particular costs are going to be for your business. The next input we're going to have a look at is personnel. Personnel, the people working inside your business, is probably one of the easier parts of the forecast to build. With your personnel forecast, you're projecting the number of employees that your business is going to hire and their respective salaries, roles, and additional benefits, so superannuation, potentially payroll tax. To make the personnel forecasting more simple, we tend to encourage you to split the personnel into different types of groups. And these groups, we typically start with direct labor. Here, you're including the employees that are solely engaged with the production of the goods that you're selling. Think of like engineers or technicians for companies that are selling tangible hardware products, an accountant in an accounting firm, or customer onboarding people in a SaaS business. These costs are not part of the operational costs of the business, but are directly related to the product that's being sold. We then break the employees down into sales and marketing. These could be managers, copywriters, social media experts. These are all part of operational expenses. We could then break the team down into research and development, managers, software engineers, those that are part of your overhead expenses. Then there's probably some general and administrative staff that are needed to keep the business together. This could be your bookkeepers, the C-level personnel, the managers inside your business. What we've put together for you is an example of what a personnel forecast could look like. And so we'll walk through this together now and help you complete one in your business. The next tab in our financial model is the people tab, human resources. Here we've given you a little bit of an example of how to complete a HR forecast for the financial model. So go ahead, you can type over anything that we've got written here in the role descriptions with the roles that are appropriate for your business. We've put a little bit of data in there just to kind of give you an idea of how it goes. So type the role in column A. We get you to put the annual salary for that position inside column B. And then in all these yellow cells here, we get you to put in how many people are going to be doing that role in any given month. You might start off with one person as a junior here on $45,000 a year for the first couple of months of operation. And then that might go to 2 people by the time we get to month 5. And who knows, maybe it goes to month 3 by the time we get to the last month of the first financial year sitting in there. So if you just put the number of headcount for each role inside these yellow squares, it'll automatically add up the wage cost and the superannuation applicable to these salaries. The next section in the financial model is the capital expenditure. So capital expenditures in accounting terms are basically the funds used by a company to acquire or upgrade physical assets such as property, intellectual property, computers, equipment, or buildings in some instances. This type of expense is made by companies to increase the scope of their operations or improve efficiency in some instances. And it can include anything from the repair of a roof to a brand new factory altogether. Typical capital expenditure really depends on what sector your business is in. Many startups are incentivized to categorize their expenses as capital expenditure rather than as operating expenses. This obviously has the benefit of putting the purchase in the balance sheet rather than as an operating expense and reducing the profits inside the business in that particular month. By putting the purchase of, say, a group of computers in the balance sheet, it allows you to recognize the cost of those computers over the period of time that they're used. And this is by way of depreciation. And so, therefore, you're recognizing the expense as you're getting the benefit out of the asset that you've just purchased. The next tab that we're going to have a look at inside the financial model is the capital expenditure tab, the Capex. This is looking at the assets, the items that you're going to get a useful life of more than a year out of. So the big cost things that we could be looking at here could include things like app development, office fit out, motor vehicle, furniture, computer equipment. So have a look at your business plan and then drop in the numbers in the appropriate month in when you expect to be outlaying for these particular items. The next part of the business model is the financing tab. This is where we determine how are we going to fund the business. Typically in funding a startup, funds could come from the founder themselves. It might come from shareholder funds, or it could come from in the form of debt or loans from institutions or friends or family members. And so in this section of the business model, it's important to realize that if we're going to be recording receipt of funds in the first year or maybe in the first year or 2 of trading, that we also make an allowance for interest to be added to any debt that's put into the business. And even more importantly, make sure there's an allowance down the track for when we're going to repay these loans, whether it's back to the founder or back to the institution, friends or family that put the money in at the start. So here we are on the finance tab of the business model that we've created for tech-ready women. Inside the finance tab here, we're having a look at the top section, which is the funds received. So you can tailor this to your business and have a look and figure out where the different sources of funds are going to come from. So as an example, inside this model, we've started off with the founder's contribution, so the business owner potentially putting in some funds. Maybe you've got seed investors, angel investors, grants, subsidies, bank loan. Maybe there's a loan from friends that's in there. And so what we get you to do here is to put in when and how much do you expect to come in from each of these sources. Equally important is making sure that if we're taking on debt, so we're taking on a loan, that we put in loan repayments, which is down in the second section here. I'll give you a few minutes just to complete your own data inside the business model. Section 5. What other elements are essential for your financial model to be a success? So we've covered all the basics in the discussion up until this point in time, and each of the tabs that are going to appear in any financial model that you create for your business. Let's have a look at some of the other elements just to dial it up a notch on what a great financial model has. We're going to have a look at things like valuation, the impact of taxes, and the working capital for a business. So let's jump in and have a look at working capital. The working capital in a business is the cash that you need in order to sustain your daily operations. Technically speaking, working capital is a comparison between the current assets on your balance sheet to your current liabilities. What things need to be paid in the next month versus what funds have we got either available or coming in the next month. This is the thing that can tend to cause a hell of a lot of stress for startup founders, particularly when the liabilities may exceed assets at some points in time. In other words, it's looking at the things your company owns and how quickly they can be converted to cash in the short term compared to the value of things that your company owes to others in the short term. Current assets versus current liabilities is known as your current ratio. So working capital is incredibly important for startups. It's basically a measure of both a company's efficiency and its short-term financial health. Working capital can significantly affect cash flow. So if a company's current assets do not exceed its current liabilities, then there's a good chance it'll run into trouble paying back creditors in the short term. And the worst case scenario is liquidation, bankruptcy. The business is over. Working capital can have a huge impact from the payment terms that your business chooses with its customers. In order to assess your working capital position, you should therefore not only steer your company based on revenue targets, but also on cash flows. Forecasting cash flow provides you with an overview of the timing of incoming and outgoing cash flows. And this is something that we're going to discuss in a bit further detail. And why is this important? When you only focus on the revenues and the expenses and not on the timing, it's easy to get stitched up. Let me explain with an example. Imagine, let's go back to the example with the 3D printers. And imagine you received an order for 100 of your 3D printers. And the business that you sold them to is expecting payment terms of 90 days because that's just what's standard for your business. However, your supplier, well, we build these in-house and we get parts that need to be paid up front. The problem with this order of 100 units is that in this example, we would need to have the cash flow available inside our business to be able to buy all of this stock before we could even make the sale. We would need to cover the cost of it, deliver the goods, and then we'd be waiting 2 to 3 months in order to get paid back plus profits for what we sold. Most startups don't have that sort of cash available, especially in their first year, to be able to sustain those sort of orders. A different payment term, whereas a certain amount or even the whole amount up front, would have completely averted the disaster that this business is facing with such a large order up front. So understanding the working capital and the cash flow cycle in your business is critical to the financial health and the longevity of your business. One of the ways that businesses can grow so rapidly is if they absolutely nail their working capital flow inside their business. The next element you've got to consider around your financial model is taxes. And it's not uncommon for a startup founder to not be overly familiar with the taxes that they're potentially up for inside their new business. I mean, every company that's incorporated in Australia has to pay income taxes based on any profit that it generates. Any business that turns over more than $75,000 in a year needs to be registered for GST. PAYG needs to be withheld from wages paid to employees, even wages paid to directors. PAYG needs to be withheld. Are you aware of whether or not your business will incur an FBT tax liability based on the type of expenditure that the business is using for marketing and for entertainment? In order to get your financial model to the next level of sophistication, it's important that you have an allowance for the tax that your business is potentially going to be up for as it succeeds and grows into the future. Many startups build a financial model for the purpose of raising funds. And part of the fundraising process is the negotiations with an investor on the valuation of the company for which they're going to buy shares in. And so the good news is when you've built a financial model for your company, all the ingredients are there ready to perform a valuation. And this is by a tried and trusted method known as the discounted cash flow method. The main advantage of the discounted cash flow method is that it values a business based on its future performance, which is perfect for a startup that might not have realized any historical performance or any historical profits yet, but expects large future earnings. During this stage, it's not uncommon for startups to not generate any revenues at all while discussing with investors regarding ownership percentages and the value of the business for which they're buying into. The discounted cash flow method is very suitable in that case, as it weighs future performance much more than current performance. The main downside of the discounted cash flow method is that when valuing startups, the discounted cash flow is nothing more than a formula, a mathematical operation. This means that the quality of the valuation is very sensitive to the quality of the inputs and the assumptions in the model. So, and look, it's basically involved on the expectation of free cash flows of the business going forward, which could be open to interpretation, but it gives you a starting point for a well-grounded conversation with an investor that's looking to put money into your business. Section 6, scenarios. So you've completed your financial model. What do we need to do before we start sharing this out in the world? Well, before you wrap up, it's worth spending some time creating some different versions of it. We call these scenarios of your financial model. By nature, entrepreneurs tend to be pretty optimistic people, which is a good characteristic to have if you're going to have the perseverance and energy to push through when others might quit. However, if we're going to put the icing on the cake, it's generally a good idea to have a scenario for worst case and best case for your business's future. Secondly, it's a good idea to perform a sanity check on the financial model to ensure that we avoid some of the common pitfalls of the financial models that we've seen in startups. Some of these errors that we've typically see if you can rate your business model against any of these. A mismatch between the financial model and the business plan. A financial model should resonate with the overall strategy. Number 2, overly optimistic or overly pessimistic revenue projections. Make sure your revenue projections are realistic. Number 3, a funding need that's not adequately explained. Make sure you've got a clear breakdown of where the funds are going to be spent inside your business. Number 4, underlying assumptions that are not clearly defined. You should be able to prove every number that's sitting inside your financial model and take that back to some research that you've done in order to put it there. Number 5, not enough employees in the team in your personnel forecast. You don't want to underestimate the number of people it takes to get the job done and the costs associated with that to build a fast-growing company. Number 6, your revenue projections are not aligned with the market size. By definition, revenues can't be larger than the size of the market that you're looking to service. Number 7, operational expenses have been left out. Maybe insurance hasn't been included. Maybe superannuation was left off the wages. Maybe there was some other cost that is essential to business that just wasn't included. Number 8, operational expenses are misaligned with the forecasted revenues. Make sure the expenses are realistic based on the size of the business, size of the sales that the business is doing. Number 9, no realistic view of gross, EBITDA, and net margin. When speaking with investors, always be prepared to answer questions about your expected margins. And number 10, disregarding the importance of working capital. Don't ever underestimate the effect of payment terms on the funding that you need. Section 7, financing. Let's have a chat about getting funds into your startup. Many startups create a financial model because they're looking to raise external funding. They're looking to get some money in their business, one way or another. So whether you're applying for a loan at a bank or trying to convince an investor of the potential of your business, or you're applying for a subsidy or grant, most, if not all cases, will need you to provide them with a financial plan. There are different ways of raising money for your business, and these can be categorized into 2 main categories. First of all, financing via debt. An example of financing via debt can be a loan, which you receive from a bank, a business, an individual, where you agree on specific terms regarding payback and interest. For startups, however, it's often pretty difficult to receive a loan from a bank, as you often won't meet their minimum criteria by way of revenue generation or the ability to offer collateral or security for the funds that they are going to loan into the business. If you can, however, access debt, some of the advantages of debt inside the business as opposed to equity, the advantages of debt mean you retain complete control of your business. You're not letting go of any shares or ownership in your business. The interest on the loan is a tax-deductible expense, so you get a little bit of a benefit back from that. And the thing that we've also seen is debt often has a disciplining effect on the management team. When they appreciate a sizable amount getting paid back each month, it can really make them appreciate the value of $1 and make sure they get as much value as possible out of the funds that they've got in the business. The other option for getting money into business is financing via equity. An example of financing via equity is when an angel investor or a VC put funds into your business in exchange for shares inside your company. And for startups, financing via equity is much more common than debt financing, because just getting a loan from banks, particularly in Australia, is not an easy thing to do. Equity investors do take a big risk in investing money in the company in exchange for shares. If the business doesn't succeed, it means they've lost everything. Unlike a loan that you might be personally liable for at the end of the day, shares, the investors are taking a punt on the business and on you as the owner of the business in hoping that it succeeds. And by giving up part of the control of your business by offering shares, you lose a little bit of the control of your business, and you've got someone that you need to share the profits with as well too down the track. And I mean that's their payback for taking a risk and trusting your business from the start. And finally, there are a couple of other ways that you might have heard of as for funding a startup that are not quite as common as the first 2, but they include things such as crowdfunding, convertible notes, or even looking for government subsidies that are relevant to your business or industry. Section 8, wrapping it all up. There are many different reasons why a startup would want to create a financial model. It might be to prove that your business plan is economically viable. It might help you be better prepared for the future. Or maybe you need to talk to another provider about getting capital into the business. Maybe it's speaking to someone to loan some funds or investors, or maybe it's even about setting up targets inside your business. We looked at two main approaches to financial modelling. We looked at the top-down method, looking from the outside in, and we also had a look at the bottom-up approach, using internal company-specific data and how much it can achieve when it comes to your growth. We decided after looking at these two methods, it's probably better to use a combination of both. For the years 1 and years 2, use the bottom-up approach where you can substantiate every single number, return on investment, where you can look at the cost per conversion and use detailed analytics in order to figure out specific details on the revenue plan you plan to achieve. But then have a look at the top-down approach when you're looking at the 3 to 5 year goal. So you're creating a financial model that's worth getting excited about with the sort of growth you're expecting inside your market segment. Typically, the outputs of a startup's financial model consist of financial statements that are your balance sheet, profit and loss, and cash flow statements. And ideally, you want an operational cash flow that splits it into monthly cash flows of inflows and outflows to make sure you never run out of cash. Some of the outputs in a sophisticated model will include things like working capital, which directly relates to the payment terms that you're dealing with your customers. A more sophisticated model will also have a look at depreciation, taxes, and capital expenditure inside your business. And given you've gone to all the effort of putting all of this financial information together for your business, it's really easy to be able to add to that a valuation methodology for your business as well too. And the valuation is absolutely critical if you're going to be talking to investors about how many shares in your business they're going to get for a specific investment that they're going to place. When preparing a financial model, it's also a good idea to have several scenarios, a best case, a worst case, or a what if this happened, or what if this happened sooner approach inside the financial model. The financial model also helps the fundraising process, as financiers or anyone that's going to trust you with money is going to ask you for a plan. How is this money going to be spent, and when am I going to get it back? Whether it's debt or whether it's equity finance, they're going to want assurance that they can trust you with the funds that they put into your business. A financial model shows that your business is economically viable and you're a trustworthy person for them to put the money with that they can expect to receive back in the future. There's a lot to take in, and there's a lot of information that needs to be sourced to create an excellent financial model. Today we've provided you with a template that you can use to get started inside your business. But of course, if you need any help, please don't hesitate to reach out. We'd be only too happy to help.